In this short video, I want to alert viewers to some developments which could have major implications for the gold price. Those of you who follow my work will be aware that I had an early tip-off last August that China was planning to introduce an oil futures contract settled in yuan. The reason this contract is important is China imports about 8.5 million barrels of oil a day, a quantity that's likely to increase as her domestic production declines and as she increases her commitment to her Silk Road projects. Now, we know that China wants to use her own currency to settle imports. The reason this is so is when she pays in dollars, her transactions can be tracked through the US banking system in New York. She does not want this information to be easily available to the US authorities as a matter of principle. She avoids this problem by settling in her own currency. But for her suppliers to accept yuan, they need to be able to hedge their yuan exposure. So China has been under pressure to introduce this oil contract. China has resisted this move so far because it has the potential to undermine the role of the petrodollar, with the potential for unforeseen consequences, not only for the dollar, but for the global economy and also her geopolitical relationship with America. America is obviously unhappy about this and can be expected to retaliate. And now that China has finally announced the yuan oil contract is to start trading in Shanghai on the 26th of March, we see President Trump punishing China with tariffs on steel and aluminium. However, Russia, Namibia, Iran, and also Saudi Arabia are either accepting yuan for oil or have agreed to do so. What does this have to do with gold? Well, two of China's oil suppliers do not want dollars, Iran and Russia. Gold matters to these countries. Iran simply requires gold for her reserves and trade payments, being cut off from using the dollar. Russia is accumulating gold reserves and has already set up a link into the Shanghai Gold Exchange. Russia is likely to use the yuan oil contract to hedge into existing yuan gold contracts in Hong Kong and Dubai with the intention of taking physical delivery of gold, effectively in part payment for her oil. There is another element to this story. On the 20th of February, the South China Morning Post published an article revealing that the Chinese Gold and Silver Society, Hong Kong's Gold Exchange, Dubai, Singapore, and even Myanmar are having talks about establishing a gold corridor for trading in Chinese standard 1 kilo bars. Vaulting will take place in a free trade zone near Shenzhen. This development is clearly aimed at encouraging gold supply to migrate to this region. The extra supply may be required to satisfy any deliveries from the excise of yuan gold futures in Hong Kong and Dubai. This is obviously a developing story which for anyone involved in precious metal markets should be watched extremely closely.